Ladies and gentlemen, we begin the session. Before I call upon Mr. B. Prasanna, the MD and CEO ICICI Securities Primary Dealership, his brief profile. A rank holding chartered accountant and cost accountant and has passed the final level of Chartered Financial Analyst Program USA in June 2005. He has been with the ICICI Group for the last 18 years. He was designated as the MD and CEO of ISEC PD in 2008 after considerable experience in trading in various asset classes. He has been a key contributor to the development efforts in his market and has more than played his part in development, innovation, growth and long-term opportunities of the fixed income markets. He has also been a part of various committees formed by RBI, SEBI, FIMDA, including SEBO-SAC formed by SEBI for the development of corporate bond market. On that note, I give it to Prasanna.
Thanks very much. Let me welcome all of you to this gathering. At the outset, let me thank Ms. It's fine now? Should be fine now. Let me thank Ms. Deena Mehta and the Indian Merchants Chamber for allowing me to participate in this wonderful seminar on Investment Outlook 2013. It's indeed a great honor to be a part of this seminar and to be specifically a part of this panel, sitting alongside a number of experts and analysts in the market. Let me do a very quick job of introducing my very eminent co-panelists here. I'll start off with Dr. Brinda, sitting right on my right side. She is right now a senior business economist, independent business economist, based in Mumbai, but we all know her as a very, very popular chief economist of State Bank of India. So she retired very recently. So she has a brilliant academic record with a PhD in economics from the Department of Economics, University of Mumbai. She is a member of the Research Advisory Committee of the Indian Institute of Banking and Finance and Banking. She was associated with the Raghuram Rajan Committee on Financial Sector Reforms in India and was a member of the Planning Commission subgroup on household sector savings for the 12th five-year plan. She has participated and presented several papers at several seminars and conferences. Ma'am, it's great to have you here. To my left is my good friend Bala, as we call him, Bala Subramaniam, the CEO of Birla Sun Life Asset Management. He has more than 19 years of experience in the capital market. He's been in various capacities in various times, head of fixed income and hybrid funds, chief investment officer, and so on and so forth. He is currently associated with the Association of Mutual Funds of India as a board member and as well as a valuation committee member. He was part of the SEBI committee on review of eligibility norms. He's done AMP, IIM Bengaluru and DFM in addition to BSc in mathematics. Bala, thank you very much for being here. To the extreme right is Mr. Hitendra Dave, very, very senior person, respected person in the markets. He's the managing director and the head of global markets, HSBC. Dave and I keep meeting, I think, only in seminars every 6 months. So I guess this is a reminder that probably we should meet ourselves more frequently. Thanks for making it here. And to my left, the extreme left is Mr. Navneet Manot. He's the Chief Investment Officer of SBI Funds, SBI Mutual Fund. He has over 18 years of experience in financial markets. And before joining SBI Mutual Fund, he was the Executive Director and Head of Multi-Strategies Fund at the Morgan Stanley Investment Management. He's done a post-graduation in Accountancy and Business Statistics and also a rank-holding Chartered Accountant. He is a chartered holder of Chartered Financial Analyst USA and the Chartered Alternative Analyst Institute US. Navneet, thank you very much for making it here. Let me start off by just giving a couple of anecdotal remarks. Venkatraman did a great job before me because the first seminar after the lunch session is always the toughest. So you have done the hard work of keeping the people awake. So I guess it's now the easier job for me to get on with the subject matter of debt markets. Just to another introduction which I wanted to say is that actually in this panel you have a wide variety of experience in the debt markets. You have people from the sell side as well as the buy side. You have people from the market side as well as the analyst community. So I think it's a wealth of experience which is available here, and I hope that I'll be able to make everyone contribute to this discussion, and hopefully at the end of the 1 hour we'll get some kind of a clarity on where debt markets are headed in the next 1 year. A very brief introduction I will give you, and then I'll request each one of the panelists to speak for a few minutes, and then we will try and find out whether there are some missing portions in the speeches and try to get out some more questions, and then finally we will open it up for the audience as a Q&A. We are at a very interesting stage in the economic cycle. There are a lot of mixed signals which are coming out in the market. When I say mixed signals, I mean, for example, on the data front, we have the GDP which has fallen off dramatically, almost like as if it's fallen off from a cliff. Nobody expected at the start of the year, but that we will actually see the 4% handle on GDP, which we saw in the previous quarter. The estimate for the entire year is 5%, so obviously it's fallen off quite a bit. The inflation has also fallen off substantially over the last 2 or 3 years. Having said that, on the flip side, why did I say mixed signal is because while GDP has fallen, inflation has fallen, the absolute level of inflation is still on the higher side. You have CPI which is still in double digits. You have a current account deficit which is still very high. So there are mixed signals which are coming from the data side. It's not a very clear picture as we look at the next 1 year. The second mixed signal is coming from the policy perspective itself. From a policy perspective, while Reserve Bank has been cutting rates, I mean they did 50 basis points of rate cuts in the last 3 months, but every time the policy speaks, so to say, has been quite hawkish. Every rate cut is accompanied by a statement which actually talks about inflation, current account deficit and all that, and clearly giving the signal that the policy room for rate cut seems to be limited. So that's the second mixed signal. The third mixed signal, I would say, is probably coming, not a mixed signal, but a mixed signal to the market, I would say, is coming from the fact that the government of India's borrowing program itself. While fiscal deficit seems to be very well controlled, and we have seen it coming down to something like 5%, which is the news today, the gross market borrowing program on an absolute basis is still very much constant. It's still quite high. So from a market's perspective, especially for the debt markets, the first view you take is normally on where is the government bond yields headed. And when you think about it, you have two contrasting forces. One is the Reserve Bank rate cuts, and the second is the potential for Reserve Bank rate cuts going forward, and the high pressure from the supply side on the government borrowing side. The fourth one is on the global front. The global growth seems to have clearly cracked down quite a bit in the last 3 or 4 years. Yes, US is recovering quite a bit, but we are seeing headwinds coming from the Euro area and Japan and UK. So the global growth scenario is not yet out of the woods. But what does it do to an emerging market like India? I mean, the first benefit that one should possibly get is a reduction in commodity prices, which then filters in through lower inflation. That is the first benefit which an emerging market, or particularly a user like India, would possibly hope for. But unfortunately, though it has happened to some extent, the fall in commodity prices is not been as significant as what one would have liked, especially when looked at it from a rupee cost perspective, because rupee is also depreciated. So that is the other problem that we are facing. And the last bit on the mixed signal part I wanted to conclude before handing over to the panelists is on the market transmission. We had 50 basis points of rate cuts, but whereas the 10-year yield moved, it's actually moved up in the last 2 or 3 months after 50 basis points. So is there a signal that the market is sending that there is potential for rate cuts going forward is less, or is it purely a function of demand and supply? Is it a technical aspect that interest rates are going up when the policy rate is coming down? So hopefully these are the things which I'm hoping that we would be discussing over the next 1 hour or 45 minutes as the experts talk out the various aspects of the debt markets. So let me start off with my panelists now. I'll now first request Ms. Brinda to start and give her thoughts, because it's always better to have a macroeconomy policy backdrop before we start discussing about the markets. So we are hoping Brinda will touch upon most of the things and of course add a lot of her own insights into the topic.
Members of the panel and friends, first of all, I would like to begin by thanking Ms. Dina Mehta and IMC for inviting me here today. We've had really a very interesting, let me begin with a caveat. Don't shoot the messenger, because I really don't have a lot of good news to give at the moment. And as Mr. Prasanna said, it's mixed or bad. Now, the first thing is, let us look at the macro scenario. I think the macro scenario is full of challenges. The first, I'll pick up from where the last panel left off. They talked about the current account deficit, and I think today that is the biggest challenge in the country today. Even when the governor presented the monetary policy last time, he said, he listed out a few risks that were there in the system, and the first he said was the external sector, the current account deficit. Next, of course, was inflation, investment, and so on. But then the biggest challenge today is the current account deficit. Now, why is this? Why we've seen 6.7%, this number which came in here at at 6.7%, but that was really a shocker. I mean, I still, that was really an exception, I would say. And this huge, it just shows that there's a lot of excess demand still pent up in the economy, and this is spilling over into the current account side. As the previous panel also pointed out, this is the difference between investment and savings. Our savings are coming down, and investment still remains on the consumption side. We're importing a lot of our requirements. So therefore, this current account has remained very wide. Going forward, how is this going to narrow? It would narrow certainly, mainly because on the export side, on the import side, we have the gold imports would tend to come down, but then the oil imports will remain high, and we again seeing fresh imports of coal. So on the export side, there is very little potential for growth. Now, within the current account, let me say there are two parts of it. One is the merchandise trade and one is the invisible trade. The invisible trade consists of remittances and earnings from soft trade exports, etc. Now, the invisible sector, traditionally, the invisible portions traditionally has been holding up on the current account side. But then we are seeing some slowdown there also, because there are huge outflows that have started coming in. India has been the investments which have come in terms of royalty, in terms of dividend, in terms of interest, huge outflows are also there. So that is again a big challenge. So going forward, we expect the current account deficit to certainly narrow steadily, but that is the first number we will have to watch. The second, the reason why the current account deficit is also being pushed up is because of a large fiscal deficit. A high fiscal deficit is a concern because it not only takes away the resources which are otherwise available for domestic investment, it also keeps the demand buoyancy up, and to that extent it curtails the flexibility available to the Reserve Bank. But then the rating agencies are very closely watching at this one particular number. So I suppose the finance minister has understood this, the urgency and the importance. So therefore we see the fiscal deficit which has been, the roadmap which has been laid out, that going forward we would see it come down to 4.2% by FY15 and 3.6% by FY16. The whole thing is still in implementation, how this is implemented, and we will have to wait and watch. The third point is inflation. Inflation remains a very big concern. 6.62 moved up to 6.8, and it would end the year by about 7%. So in the current year, inflation, even though it has come down below 7% in terms of WPI, in terms of the retail inflation still remains very high in double digit, and food inflation remains in double digits. So, and fuel inflation, which the deregulation as it gets passed through, we would find that also pushing up the inflation. So therefore, challenges remain on the inflation front. Our own expectation is that perhaps it will come down to about 7% by FY13, but in the near term, it will still remain 6.5%. So all this is compounded by a slowing economy, which is touching 5% in the current year, a 10-year low. Going forward, of course, we expect that this would be the finance economic survey has said 6.1 to 6.7% in the coming year, and it would take at least another 2 years before we can go back to about 8% growth. So the challenges remain very much in the current year, but in the medium term, I think the India growth story is still pretty robust, but of course it cannot be taken for granted. Why do I think that the drivers, the outlook for the medium term is good? Because the drivers of growth are very much in place. One is consumption, second is investment, and third is the export side. I think these will drive the Indian economy, and in the medium term they are quite robust. demographics is the main driver for growth. I think we heard that in the previous session before lunch, that demographics would be a big, between 2010 and 2020, India would add something like 136 million to the working age population, while while to the 60 plus age group, it would add something like 23 million. While China at the same time will add more than 100 million to the 60 plus age group. So India is the only country in the world at this time, perhaps a little, maybe South Africa, which is going to see an increase in the working age population, and this group is going to add to supply of savings, investment, demand for cars, demand for housing, demand for leisure, travel, financial services, is going to give a big push to all this in the economy, and that is why the whole world is looking to India and saying this is not only Asia's century, this is also India's century. So my optimism springs from this, and of course on the investment side we will have investment driven by manufacturing sector and investment in the infrastructure sector. In the long term, we will see medium term, we will see GDP come back to 6 to 8% growth between 2015 and 2018. 7 to 8% growth, and inflation would it would moderate to about 5 to 6%. Now, having said this, in the next 2 minutes, I can just what needs to be done. Because this is a structural slowdown, we need structural reforms. As Mr. Prasanna also said, we have to look at reforms in the economy, and some steps have already been taken. But we need to continue to reverse this slowdown, so we'll have to give a push to investment in industry and agriculture. I think agriculture has remained quite, it hasn't received the attention that it really needs to, because that is one sector which will really give a push to in growth. For example, with the same amount of arable land, India and China have almost the same amount of arable land, but China produces something like 400 million tons of food grains, and we produce something like 250 million tons. So we have to increase productivity across, not only in agriculture and industry also. The second thing, of course, I would say increase in investment and savings. Asia traditionally, because we have a very high culture of savings, so that has stood us in good stead. But in the last few years, we find that the savings, household savings is actually fallen. And more worrying is that the share of savings in financial assets has fallen, and most of it is going into gold and housing and real estate, etc. So we need to get this back into the financial sector so that this can be intermediated for investment. The third thing that needs to be done is infrastructure. I would say physical infrastructure and social infrastructure. Social infrastructure, education, healthcare. I think these are the biggest things, education particularly. And because if we are going to have a workforce which is going to come into this age group which is going to be in the workforce, if they are not educated, if they are not skilled, if they don't have opportunities for jobs, then I think we'll have a very, very major problem on our hands. With something like 12 to 13 million would enter the labor market every year. So our economy has to grow, industry has to grow, and we have to make sure that we have enough jobs, enough skills, enough education to take care of this. Otherwise, it's really going to add to the other problems that are already there. On the monetary policy front, I would say India would benefit from a more accommodative stance. But there is, I see a very limited space for further monetary policy cutting. I think perhaps in my view, maybe up to another 2 rounds of 25 basis points, up to 50 basis points, but that would be only till September. Because the window of opportunity for rate cutting is very limited. Because inflation is going to start trending up after September. Base effect plus the increase in fuel prices, etc., is going to see a reversal, and so inflation is going to remain under pressure. And so therefore we need to reverse the growth, but monetary policy can do only that much. What we need is from support from the fiscal side and support from the reform side. And finally, I would just make a last point on the global environment. the environment is improving, of course, but it's and as we have seen that the U.S. economy is pretty poised to take off. But at the same time, we are going to see rates remain flat for certainly 2013 and 2014, and maybe sometime only around very late in 2015 or there only after that can we expect to see any reversal in the policy which is being followed by the advanced economies. So my last point would be, is there a bubble building up in the bonds? And I would say yes. But is it going to burst? I would say not anytime soon. Now, this is because the flows are still supportive of bonds. In fact, the QE Fed purchase program is going to purchase 40 million mortgage-backed securities every month and 45 billion US Treasuries every month, and till the unemployment level reaches 6.5%. So we are going to see them go through this for a long time. Now, foreign central banks are also buying into UST. In fact, though China is the largest holder of US Treasuries, more than $1.3 trillion. Now, between last year and this year, the latest data which I have is for December end, that China has actually reduced its holdings of US Treasuries, but UK, India, Japan have actually increased. They are buying more of US Treasuries. And banks have also, US banks have also excess cash, and they are also investing in US Treasuries. In fact, they are holding more than 100 billion in US Treasuries as compared to last year. And there's an aging population. In fact, what we are is exactly the opposite of what's happening in India. The aging population there, now these, they will be saving for their retirement, and they would invest in safe assets such as bonds, and the demand for equities would be very low. So this again is going to keep up the pressure, keep up the demand for bonds. And of course, pension funds looking for yields would also be investing here, because as the demand increases, the yields are also going to go down. And finally, the fiscal cliff. This would cut down the US deficit. So therefore, there's this data that, actually the deficit which would come in, the fresh issuances would be about $821 billion as against 1.2 trillion last year. So therefore, with the Fed buying 45 billion every month, that is, in 12 months, it would buy about 540 billion. So there would be only 281 billion of additional new treasuries that would be available to investors. So therefore, in the near term, we can see the bond market still very comfortable. And but again, this is a huge challenge. You never know what is going to happen. There is so much of uncertainty in the global economy that in case there is any reversal, because we'll have to be prepared for an orderly winding down of this excess liquidity that is there in the global economy. And India also will not remain immune from all this. So we'll have to wait and see. So our policies will be tempered by what's happening globally. I think I will just end here. Thank you.
Thanks, Brinda. So I think the biggest or the most important takeaway for me, for all of us, is the fact that she has a view of 50 basis point rate cuts over the next 6 months. So that is the bottom line for all of us and out of all the discussions. I have a few questions which I'll probably come back towards the end after we finish off all the other. Actually, she finished with the global backdrop, which connects me nicely to the next person whom I'm going to call on. We talked a lot about the challenges in the Indian economy, about the inflation, fiscal deficit, current account deficit, which seems to be on the top of the challenges which is there. So the question is, how are we going to finance it? Are there enough steps which have been taken to finance this current account deficit? Is the inflows going to happen? Because at the end of the day, we need foreign capital. So are we doing enough to attract? If not, what is going to be the view on the Indian rupee? And if the view on the Indian rupee is good or bad, what implication it has for future potential inflows into the economy through the debt route? To talk about all this, none better than Mr. Dave. Dave, I'll request you to...
Thanks, Prasanna, and thank you, IMC, for inviting me to speak here. I think as far as global market outlook is concerned, I think Brinda has already covered that in reasonable detail. I think by and large, given where we are today, I think in the previous panel we spoke so much about the current account deficit and things like that. unfortunately, at a level, we almost have to hope that the world remains as is for the next few years, so that there's enough money going around and it comes to us. So, and anyway, I think as you will figure out as this panel goes on, the fixed income market is a market which loves doom and gloom. So every time equity market is down, we guys are cheering in the bond market. Every time, there is a chaos somewhere, I think it's unfortunately a market which is cheerful only when the world is unhappy. And given the state of our economy, it's almost in that situation. I would tend to by and large think that there is nothing which suggests that the global market is going to turn around in any meaningful way fairly soon. And we have to take into account the fact that not only are interest rates zero, almost every major central bank is doing tremendous amount of quantitative easing. Fiscal budgets have been stretched in most of the G3, G7 world. If with all this, US unemployment rate has come from 9 to 7 or wherever it is in the last month, and we'll know for this month in the coming 2 days, I think you just know that there is a possibility that a large part of the world has become addicted almost to some kind of permanent, so stimulus by definition which is meant to be withdrawable might be a permanent state of being. And to that extent, therefore, liquidity and interest rates will eventually help will find its way into markets which are attractive. I think on the rupee side, most of the previous panel discussed quite a bit there. I would just say that I think you have to be an enormous optimist right now to be bullish the rupee. Okay. That said, for the last 12 months, it's not gone anywhere at all. So all the data and everything would suggest that the first thing you should do is buy dollars spot, buy dollars end of this month, next month, and the month thereafter. That costs you money. If the rupee doesn't go anywhere, then you will, regret ever listening to something like this. But on the currency side, there is a fundamental challenge. And yes, rupee is remaining stable because, very frankly, our finance minister is doing an excellent job going around the world and making sure that despite all the macro challenges, he highlights the structural positives, gets investors, whether in equity, whether in debt, whether FDI related, he's promising to fix issues. So I think it's he's got a tough job on hand, and the fact that we've got 12-13 billion dollars in the calendar year so far, 24-25 billion dollars last year is a very, very creditable achievement. You have to say that's a super good pitch that he's making around the world, and let's wish him all the best because we need all the monies. I think the problems with not having a current account which is adequately funded were discussed in the previous panel. You could have currency not just weaken but become a source of instability itself. There are a lot of companies which have borrowed in dollars or dollarized, and there are other, we import a lot of oil, so all those issues will be there. In terms of coming to the issue of FII interest in India's debt market, I think, in fact, it was at a previous IMC panel discussion like this, which I believe Sashi was moderating that time, where I had highlighted that while our equity market is so simple, you can be sitting in Oslo, Frankfurt, London, New York. You want to buy shares, you just come to the country, open a custody account and buy shares. But for debt, we had made this really difficult structure. And, I as a part of my job, one has to interact quite a bit with offshore-based people. I must tell you, we are able to see through complexity a lot more easier than they are. It's a simple, can they come and buy or not? But the debt infrastructure there was a government securities bucket, within that there were 3 sub-buckets. And there was a corporate bond bucket, and within that there was a bucket in terms of tenor restriction. If you buy, you could not sell. Then there was the end use, was it an infrastructure bond or not? So ultimately there were 10 boxes, and before buying a bond, the buyer had to choose. And this is typically, as we have 2 fund managers here, and I'm sure some of you have also experienced, but most people don't like that complexity. We are a country which desperately needs the money, and I made it so difficult. So I'm very, very happy to read what has been effected just 2 days back through a SEBI circular announced by the finance minister 10 days back or so. That is now simplified. There is a $51 billion corporate bond bucket and a $25 billion government securities bucket. And that's how people would like it to be. Now that is being made a market comparable to what the rest of the world has, and we are already beginning to see, some effect of it, that people who want duration, 5-year bonds, 7-year bonds, 10-year bonds, 15-year bonds, 20-year bonds, and the kind of investors the country ideally has been seeking, reserve managers, sovereign wealth funds, real money, pension funds, mutual funds, etc. I think the inquiries from those have really, really gone up in the last few months, because a lot of us were also already indicating that this is bound to happen. So I think as far as FII interest in the debt market is concerned, think about it, India's 10-year bond is 8%. I'm not even sure of which other market comparable is anywhere close to this. I don't think there is any economy in the top 20, top 25, top 30 where interest rates are as high as this. It is quite unfortunate that this has coincided with the current account being what it is, and therefore by and large a negative view on the rupee. But if one of the two gets addressed, you can sense that India's fixed income markets will actually generate a lot more interest going forward. I think the only other point I would just mention is inflation was covered in detail. I think I would like, I think us on the panel and people here and at the wider society level, that the inflation-linked bonds which are being contemplated, the gold-linked bonds which are being contemplated, I think they are really being done to address the current lack of interest in fixed income market by domestic savers. And to the extent that we can help ourselves in making sure that the product structure is such that it meets market expectations and issuer expectations, I think that could be one of the things which could not just increase or channelize money into the financial market, but also eventually give us a sense of what is the real inflation expectations. Right now we just have this soft thing that inflationary expectations are running very high. There is no way of knowing, is it your expectation, is it my expectation, is it our collective expectation? But once you have people, people can buy bonds linked to the whichever inflation benchmark, I would think then you will start having a measure which is, well, quantifiable and measurable. So maybe I'll conclude there and we can address any other issues thereafter. Thank you.
Thank you, Dave. So I'll probably come back towards the end when I want to, if I have the time, we can deliberate a little bit more on some of the things that you've touched upon. He's also done a very good, made my job easier of linking the next person who's going to come and speak on the subject, is about are we doing enough on the retail side to attract household savings into the debt markets? So that brings into focus the two significant fund managers in the country who are here with us. So they are on the buy side, and I would request Bala to first come and speak. Amongst other things, he can talk about what mutual funds are doing to attract household savings into the debt, and how to attract retail people. What about the borrowing program? The interest rates, are they looking to go up because of that, or is it going to go down because of the Reserve Bank policy? Bala.
Thanks, Prasanna, and good evening to everyone. Of course, we keep discussing every pre-monetary policy, post-budget, every year on predicting interest rate view and predicting government borrowing programs, and see how the impact on that is going to be on the bond market. And the last 2 years, after every policy, if expectations are not met, which is nothing but rate cut not coming in, the fund managers cherish, they feel happy. And we as a people who are supposed to build the business on mutual fund, we also feel happy. The simple reason is as long as interest rates remain high, that much better for us to build fixed income as an asset class in terms of giving solution to other customers. And the last 2 years, believe me, the entire fixed income space has been built in the mutual fund space. Is only on the basis of the rate cuts not materialized. I would have given a prediction that 50 basis points cut will come, but eventually it will be either none or it will be 25. But you will never feel bad your call has gone wrong, because the rates are going to still remain high. So, which is, I think the earlier speakers clearly talked about the rate cut is there, but not to the extent of what otherwise would have liked it to be. So 50 basis points cut, which essentially means that it is neither here nor there from the bond market perspective. It's remaining at a level which you and me as an investors would feel comfortable to come and invest. So that's actually give us a great opportunity. The last 2 years, and the mutual funds have done a great job in terms of promoting fixed income as an asset class to the investors at large, including the retail investors. From the fact that equity is an asset class, the bullishness is there, but you don't have the conviction of putting your money given the lot of uncertainty. At the same time, on the fixed income space, as we always live on the equity, the hope remains on rate cut. The rate cut not coming in and not having an impact on the bond market provides an opportunity for us to go and build size in the fixed income. As a result of that, the last 1.5 years, clearly the mutual fund industries have gone and expanded on the fixed income asset class through the duration product, which includes government securities, investing in government securities, which includes investing in corporate bonds. And that has benefited significantly in terms of one, attracting flows, second is giving a better experience to the investors, and third, also helping the bond market to behave in an orderly manner, which is nothing but for every demand, every supply, there is a demand which is coming from mutual fund as well. And that has given actually orderly bond market, which is of course is ultimately an outcome. It's coming to the point that where do you see the yields moving, and which again try and in terms of predict where it could be, knowing very well that the government has done a great job in terms of containing the fiscal deficit, at least to the budgetary numbers. We always have a question mark in terms of how the math adds up to. And the questions we have every year, the math at times it adds up to, sometimes it doesn't add up to, but we don't have much choice but to ensure that get to the number, whichever way we do it. Sometimes we do it through the expenditure cut, sometimes we do through increase in revenues if possible. And today it's in a very challenging time. And yesterday I was talking in one of the forum, and where I just felt that we have never been a challenge-free economy. We have never been a challenge-free economy in any manner you look at it. We always have challenges. And a very recent economist has covered about India very nicely, and has prized India on the cultural connections which you bring to the global the economy like Western world. But clearly they talked about some of these negatives, which is nothing to do with the economy, but something to do with where we are not going to spending enough money with respect to the defense. And that's why they have covered it very nicely. Assuming we have to spend a lot of money in terms of improving our defense, the capability in terms of creating the infrastructure, clearly we need a lot of money to spend. So all those things has to come out of the fiscal. And second, math, which I think has done very smartly for last year on the basis of last year's experience. I have been in the market for so long and never seen such a smooth divestment of the public sector enterprises, which has happened. Not many have noticed. Sometimes they just come in the morning and just close the issue. And many of the portfolio managers may not even know actually yes, so much of divestment has happened. And with the reason which happened in the case of SAIL. And the government has done a smart thing in raising more than 12,000 crores from the market, which has made them believe that the bullishness of the market will remain even going forward, especially with respect to equity, which will help them actually rise 40 to 50,000 crores of money. And clearly in the fiscal deficit math, where there is a hole which we believe that is there, apart from the other speakers spoke about inflations and etc., is the how the numbers are going to be achieved, which is divestment and spectrum auctions, etc. You need to have vibrant capital market to make this really work. So which again means that the bond market is not going to be in a hurry to rally, which is again, it makes our business much more easier to go and build that's asset class big time. The last which we are quite bullish is on the global investors coming to the bond market, clearly which is linked to the rupee dollar movement. I think one of the area where I have been quite bullish for quite some time, unlike the past where the reaction time from the regulator, they used to be relatively slow, used to watch and then react. But this is time around that every policy makers, whether it is SEBI, RBI, or even Ministry of Finance, the number of meetings which I as a mutual fund representative would have done with the Ministry of Finance and other the regulators, quite amazing. I mean the speed at which they react to the market and the speed at which they react to the listening to the market players and make suitable adjustment on the regulatory framework is quite immense. And I have seen that happening in the case of the mutual funds. I have even seen that happening in the case of attracting forex flows into the bond market. And since the time they introduced, they increased the limit for the bond market being made available for overseas investors. And finally, the last week, when the Ministry of Finance, Finance Minister was on a overseas travel, he announced that they will look at the entire limit monitoring system in such a manner, the whole they come in actually through the automatic route, as it currently happens in the case of certain FDI segment, which I see it as quite a proactive step which the government is willing to take, which is nothing but making the systems enable to get any kind of inflow that could come from overseas market as and when the time is ripe, which essentially means that though the views we are expressing at this point of times is a little difficult for the rate cut to come, as a result of this the bond market is not going to rally in a hurry. At the same time, so we need to be mindful of the fact that the global market liquidity, if it remains for too long, ultimately everybody will come under pressures when it comes to the question of generating portfolio return. And that's equally applicable for overseas investors as well. And the kind of limit which has been opened up, and that could probably be playing playing a spoiled sport in terms of bringing on the bond deals quite sharply, and which is nothing but the large pool of limit that is available for global investors to invest in India, and any provisions which so far has been hurting them coming to India in respect to the easiness at which you come, and those actually hurdles are being removed. As and when we see actually that marginal ripe actually is getting prepared for the money to flow into the country, easily we'll see the foreign flows into the bond market. We always foreign flows means what we think about is an equity market which has seen complete surprise in terms of attracting such a large flows from overseas investors. We'll probably see the repeat of that even in the bond market, which makes the mutual funds also to play a bigger role in terms of serving that market as well in the form of advisors. And the last, of course, I think you talked about bubble. I thought, let me just make it a point mention, bubble or burst, which I believe that it is not meant for the Indian bond market. It is meant for US market. Yeah, it's a bubble, yes, US market. There have been predictions the last many years that US bond market will bubble. The probabilities could be quite high, which again makes the investors, global investors, look at something different. Earlier, the economy which is growing at about 5.5%, which is far higher than any global economy that we are seeing. The policy framework in India is far superior. Despite all the issues, we are superior on the policy making. All those things will only make that the environment far more superior for attracting global flows, which again our belief is will make the bond market to remain somewhat buoyant from the investors' point of view and giving a better experience to the investors' point of view. Thank you.
So Bala talked about the fact that every policy which passes without a rate cut is actually time to rejoice for the mutual funds, because they go and tell the investor, abhi aane wale hai. So something similar happened on the trading community also last year. We had 8 policies. The first and the last 2 policies had the rate cut. But every single policy, we all expected rate cuts. Though the RBI telling in very clear language that the space is limited, we are not ready to do it, and though inflation was high, we all kept expecting rate cuts. It didn't happen. Yields go up, and then by the time the next policy happens, it comes back to the same level at which it was prior to the previous policy. So hope doesn't die hard, I must say. I think that's similar for the mutual fund industry as well. Thanks, Bala. So now I would request Navneet to come and finish the missing puzzle. I hope he will give us some direction on where interest rates are headed by the end of the year.
Good afternoon, friends. I was just trying to note down that which word would be the most repeated words right since morning. I mean, we have been sitting here since 9:30 in morning. Then I thought of lots of words, and finally I realized I think it would have been current account deficit. By that time, I mean, you would have heard this word so many times, whether it was currency panel or even in the commodities panel when they were discussing gold, or even the earlier one when I think Dina started, whosoever started, right from that. I won't talk too much about the macro. I think you would have heard enough during the day, and actually it doesn't really matter for the investor. What really matters is the direction. Where I mean, any inflation or current account or fiscal or anything, where it is, I mean, it doesn't really matter to your portfolio. What really matters is the direction of change. What really matters is into the valuation. What is there in the valuation? And what really matters is how you can take an advantage of that. As Bala rightly mentioned, that because the interest rates have been higher, investors got a lot of opportunity. So India's fixed income market, I mean, still offers huge amount of opportunity. In last 3 years, investors in my dynamic bond fund or income funds have generated double-digit returns despite the fiscal deficit going up, current account deficit going up, inflation, rupee depreciating and everything. Because each of these macro challenges always offer opportunities to investors. Now think of an investor who's sitting in US or let's say Japan, Japan is running a current account surplus. I mean, let's say in case we move to current account surplus, not that all your portfolios will start looking great. There, I mean, the investors are struggling to earn even the 0% returns on their money market fund. In US, I mean, there is this famous quote called that Treasury, I mean, we used to invest in Treasury thinking that it's a risk-free return. You get risk-free return, but now they are priced to deliver return-free risk. Because, I mean, you are getting 1.8% in 10-year Treasury. In Japan, you get 0.6%. Sitting in India, I think we are far better off for most of the investors. And that's why the new talk in US is buy bonds, buy equity. BYE, buy bonds, and BUY, buy equity. And equity markets have been doing well. Investors are shifting money. In India, my message would be very simple. Buy bonds, buy equities. I think opportunities are in both the places. So, I mean, as a macro, probably was much worse in 1991. But if you invested either in equity or bonds, I think it would have been a great time to invest in both asset classes. 97, 98, I mean, some of us who were in forex market or money market, I mean, if you remember, rupee was just tumbling and it was like, again, we had a coalition government, much worse than what it is today probably. I mean, the prime minister was changing every couple of months and there was hardly any decision. But if you invested, I think you would have reaped a huge benefit. We had a like 5-year bull market in fixed income, massive bull market, and we had like 2-year great equity bull market in 99 and 2000. And similarly, like a couple of years back in 2008 when people wrote off, whether you invested in bonds or equity, you made decent money. I'll take another 2 or 3 minutes on macro. Won't again repeat the word current account because to me, I think the entire genesis of all our macro problems today, whether it's the current account deficit, whether it's the high inflation, high interest rates, whether we have the substantial decline in the savings rate, and because of that, I think the whole investment cycle has slowed down. His genesis on only one thing: the UPA's policies of doling out cash without augmenting the supply side. So you've doled out so much of cash in last 5 or 7 years, you created a huge demand without creating the supply side. So that's why we are importing more, and that's why we have higher inflation. That's why the RBI had to keep interest rates high. That's why we have such huge systemic liquidity shortage for last several years. I think that there are now serious efforts, not that it would have come out of conviction, but the sheer compulsion that you can't allow a downgrade of this country by S&P. Simply that sword has done the trick, and probably you won't see the fiscal profligacy that we have seen in last couple of years. I think to me that starts probably a better macro cycle going forward. Because of that, I think automatically, given the output gap, we should grow at 7%. We are growing at 5%. Global economy is growing at a much lower rate than potential, so commodity prices are likely to remain soft. RBI has kept money quite tight in last couple of years. All these factors should keep inflation in check going forward, should bring down the current account deficit going forward. As the real rates have turned positive, because I mean you didn't have an incentive to save, and that's why somebody was discussing about the decline in savings, because you had 9% inflation and 9% bank deposit rates, and that's why and also the overall income growth has slowed down, and government was just saving, corporate profit growth has not happened. So obviously the savings have gone down. I think probably now the real rates are turning positive, and then the savings is likely to increase. To me also another big challenge, one is the decline in saving, and another the diversion of saving from financial assets to the physical assets, which Ethan talked about. I think it's a serious challenge as a nation we are facing. Going forward, we can face an acute shortage of risk capital if the domestic investors are not investing either in the bond market or in the equity market. And as a nation, we are making ourselves so vulnerable to the foreign capital that any risk on, risk off move makes our economy, all our markets extremely vulnerable. So I think policy reforms, huge policy reforms, a massive change in mindset is needed at the regulators level and at the finance ministry policy makers level, how to get savings back into the financial markets. I think as a market start delivering return, that would be like one of the catalysts. If you see that equity market is delivering return, markets are showing signs of stabilization, you think that deposits are offering real returns. Also, I mean, as we have shown in the mutual fund industry, the way short-term funds, income funds, dynamic bond funds have delivered return, tax efficient, very decent double-digit returns. I think overall flow of savings from savers instead of physical assets to financial assets is likely to gather steam in the next couple of years. I think it's only a matter of time. The ownership of equity or ownership of, I think, bonds in individuals' portfolio is at a multi-year low, probably a 25-year low. It can't go lower than this. I think the investments into gold and real estate has really taken away bulk of the savings, but it can't continue like that. And we have seen periods, I mean, everybody thinks that gold is a great asset class, but there was a period of 20 years where it didn't deliver any return. In dollar terms, of course, the rupee depreciation delivered little bit of return to the domestic investors. Mr. UK Sinha this morning was talking about the same thing, that the savings not coming into the official channel, and he thought that, and his prognosis was that because of this huge grey market, that lots of these chit funds and all kinds of saving vehicles are taking away a lot of money. Of course, that's a concern. But to me, I think the diversion towards the physical assets is a much bigger challenge that we need to deal with. We have to make capital markets far more conducive, I mean, for the investors to far more attractive. So you can't have a situation where for buying probably a 10 lakh rupees of necklace from a jeweler in Javeri Bazaar, you don't need any KYC. I'm hearing that it's going to change, and in a mutual fund where for 50,000 rupees, I mean, the kind of effort that you have to make for KYC and everything. I think that fundamental shift in mindset is needed. Going forward, in terms of to close my talk, in terms of opportunities, I still believe that rates are headed lower. Another 50 basis point probably from the policy rate side in another 3 to 6 months time. Policy rates are likely to decline. I think softening in inflation. I think current account deficit is likely to soften significantly in the next couple of quarters. And then I think the markets are giving good opportunities. The bond yields are quite attractive across the yield curve. Even the 10-year bond close to 8% today, maybe a little higher as the supply picks up in the next couple of weeks, but that would be a good opportunity to buy. If we expect given the moderation in the economy and softening in inflation, probably yields can fall 50 to 75 basis points from here. That offers a good opportunity for investors who have the horizon of over a year to probably make good returns in our income fund or dynamic bond funds. Similarly, at the short end, if you don't want to take too much of risk, money is there for, let's say, 3 months, 6 months, 9 months. I think even the short end of the yield curve is quite attractive, where you get 2-3 year corporate bonds and 1 year bank CDs anywhere between 8.5 to 9%. I think that's quite attractive in terms of current yield, with the possibility of making some amount of capital gain. So I think depending on your horizon, I mean, if it's more than 1 year, then I would argue in favor of income funds and dynamic bond funds. In case it is anywhere between 3 months to a year, then even short-term funds are offering good opportunity. And similarly, I mean, for keeping your cash, as Bala said, it's good that RBI doesn't cut interest rates, and then the short end of the yield curve is quite tight because of the tight liquidity, even in the liquid funds and ultra short-term funds, where theoretically, I mean, there could be risk, but practically there is hardly any, there is no interest rate risk, no credit risk, or no liquidity risk, and then they are offering like 8% plus kind of returns. So I think there are opportunities in fixed income. And again, though I'm not part of the next panel, but again, I'll just repeat the word for investors sitting here. Despite all the macro challenges which are there today, I mean, we are looking at the last 5 years and then trying to, obviously, I mean, we have done everything bad that we could do to our macro, but the next 5 years looks far better than the last 5 years. That's why buy bonds, buy equity. Thank you very much.
So thank you, Navneet. I think between Navneet and Bala, they've done a beautiful job of selling all mutual fund schemes. I don't think Navneet has left out any single asset class out when he said buy bonds. Thank you, Navneet. I don't think we have too much time for questions, so I'll try to wrap it up very quickly. Maybe just one question I would like to ask Dave. You actually made a statement that it requires an enormous optimist to be bullish on the rupee right now. I mean, the reasons are quite obvious why you said that. But at the same time, there seems to be a lot of inquiries from foreign investors and people who are looking at dollar returns, investing in Indian government bonds. So why do you think that interest is, I mean, of course, notwithstanding the fact that interest rates are high, on a currency adjusted basis, do you think the returns will still be good for them, superior to what they get in their own markets? Or do they come on a hedged basis? Can you throw some light on that?
I think it's a very relevant question. I would broadly categorize offshore investors that we have experience with who have bought local currency bonds into two categories. One is effectively, I would say, prop books, traders, people who buy 1 or 2 year bonds and tend to hedge for as long as possible. And those are the people for whom it was a pure carry trade. If the INR interest rate was 7%, if the hedging cost all in, including the cost of funding, etc., was say 6%, they were making 100 basis points risk free. And then you can put on, whatever size you want, $100 million, $200 million, $500 million. And, if it's 1% per year and if you've got access to $500 million of funding, which is not so difficult offshore, then you have a $5 million per year trade. I mean, you don't have to do anything at all. Just buy on day one, hedge yourself on day one, as long as Government of India honors its obligation, which, let's face it, everywhere in the world, we do believe that will be the case. So I think that's one category. The other is, and that's the one which I alluded to in terms of serious interest from sovereign wealth funds, real money people. My experience is, by and large, these people do not hedge. As to the question as to why, despite all the CAD related issues, why they buy, I think India is clearly going to be an economy which is incrementally going to contribute top 3, top 5, top 7 to incremental GDP in the world for the next 20 years. I mean, that there is no debate about. We are unhappy about 5% because we should be unhappy about 5%. So a lot of people would want to start allocation into Indian fixed income markets, and where they are starting off with is next to nothing. I mean, I have had discussions with 2 sovereign wealth funds who have told me that their debt incremental allocation, they want to weigh to the incremental contribution to world GDP growth. So if you see, that was one, somebody else may have some other thing, but whatever that be, in terms of relatively large and reasonably well managed, regulated and liquid bond markets, in the emerging market space also, India is actually quite a shining example. So I think that attracts me.
Okay. Just a quick question on the retail side. I mean, the way beautifully handled on the institutional side. It's to my colleagues Navneet and Bala. On the mutual fund side, are there, the slew of tax-free bond issuances, for example, creating very good after-tax returns in the hands of the retail investors. And on the contrary, the dividend distribution tax has actually been increased for debt mutual funds very recently. So where does the debt investment returns fall, and do you think investors would still be interested in coming to the debt markets through the mutual fund route?
I think the dividend distribution tax actually has been pending for last 2-3 years. That it was supposed to get addressed, and finally it's been addressed in this budget. Hence the industry did not see it as a shock, and even the investors did not see it as a shock, especially the large pool of corporate and HN investors coming in. Having said that, I just did a simple analysis. And there is a tax-free bond issued for 5 years and 10 years, ranging between 7.75 to 8.25. General the tendency to go and join the herd and try and see actually how much allocation I can get, which I have seen in the last few years. People do queue up and buy. At the same time, there are few issuances have been a failure actually of late, because the rates that were offered actually was much lower than the bonds which are offered earlier. I just did a simple analysis. If somebody had come into the liquid fund, which is no risk in any manner you take in that schemes. There is no interest rate volatility much, there is no credit or risk. And it's given an average of roughly about 8.25, 8.5%. And mutual fund scheme, fixed income scheme is only asset class gives an opportunity to hedge against inflation in the form of a double indexation benefit. In the longer the period you hold, you are able to adjust the inflations against the return and pay tax only on what is left out. That not many have still understood actually. If I do that, the liquid funds is given a tax-free return of close to about 8%. And that's why our belief is more and more investors would actually choose to come into the longer term, which again is going to be making the mutual funds do much better in terms of portfolio management, as well as it will create a higher liquidity in the capital, in the bond market. In many sense, it's only going to be make the life easy for the mutual funds and the portfolio managers, as well as the investors.
Thanks, Bala. So, the short conclusion of this 1 hour of discussion is that I think there are a lot of challenges in the short term as well as the long term. The long term, of course, looks very good because of the demographic dividend that India provides to the world. The short term challenges can be overcome over a period of time. But I think the current set of variables, anyway, I think over a period of the next 6 months will dictate 25 to 50 basis points of rate cuts by the Reserve Bank. So the asset market returns do look good as then when these rate cuts happen. It should hopefully flow through into the bond yields and the bond prices and hence flow through to the rest of the system. Mutual fund investments are as attractive as any other investment. So debt markets is also the place to be in addition to equity markets. That's the short conclusion. So thank you very much for attending and hearing us. So,
thank you very much to our panelists. Now may I request Mr. Dushan Dave to hand over the mementos to our panelists, please. Mr. Dave. To Dr. Brinda Jagirdar. So, to Mr. B. Prasanna. To Mr. A. Balasubramaniam. Mr. Hitendra Dave. Mr. Navneet Munot. Thank you. Yeah, we just have a group. We request for a group photograph over here, please. Okay. Thank you.